Hey, it's John Hobbs here, Senior Analyst for Income Shares and Leverage Shares, and welcome to the first video in our series on Options Income ETPs, aka Exchange Traded Products. In this video, you'll get a basic overview of what Options Income ETPs are, how they work, and why investors might use them in their overall strategy. So without further ado, let's jump in. And here's what you'll learn in this video. Number 1, what an ETP actually is. 2, how options income strategies generally work and what they aim to achieve. Then number 3, a quick primer on call and put options. Number 4, the 3 main income strategies used in exchange traded products. And number 5, the key risks to know when considering income options strategies. Okay, so let's start with the basics. What exactly is an ETP, or exchange traded product? Well, Warren Buffett famously said, "Price is what you pay, value is what you get." That's true for stocks, but with ETPs, it works a bit differently. An ETP, or exchange traded product, is basically a wrapper that trades on a stock exchange just like a stock. But unlike a stock, where the price moves with buyer and seller demand, an ETP's price changes with the net asset value, or NAV, of what's inside that wrapper itself. That can include stocks, bonds, other funds, or, in the case of options income ETPs, the value of its options positions. You can think of an ETP as a transparent basket that updates in real time. That's because big traders called market makers buy and sell the ETP shares to help keep the share price in line with its NAV. So, while Buffett's quote applies perfectly to individual stocks, the goal with ETPs is generally for the price and value to stay the same. This way, when investors buy ETP shares, they generally get what they pay for. So now that we understand ETPs in general, let's move on to income options ETPs. As the name suggests, an options ETP is an ETP that trades options, which aims to earn income for its investors. To do that, it will sell call or put options on certain investments like stocks, gold, or even stock market indices like the Nasdaq. Since the ETP is the option seller, it can earn income from selling those options. That's because the option buyers essentially pay the ETP a certain price or premium for those call or put options. The ETP collects those options premiums so it can distribute regular income to investors, say once every month. Depending on the options strategy, the ETP may hold some exposure to the underlying investments themselves, but more on that later. Now, before we go on, I'll give a quick primer on call and put options because these are what the income ETPs sell in order to generate potential income. So let's start off with call options. Put simply, a call option gives the buyer the right, but not the obligation, to buy a stock or other asset at a certain price called the strike price, at some point in the future. Here, the option buyer is betting that the stock price will rise above that strike price. If the stock price does rise above the strike price, it makes sense for the option buyer to exercise their right to buy the stock. They can then buy the stock at the strike price, which is a bargain compared to the current market price of the stock. In other words, call option buyers can earn a profit when stock prices rise above the strike price. But for the option seller, it's the opposite. They would need to sell the stock at the lower strike price. We call this options assignment, and it's one of the main risks of selling options. But that's all part of the trade-off for the option seller. They get paid a premium upfront to sell that call option, which they keep regardless of the stock price. And on this hockey stick diagram, you can see how the option seller's profit is capped at that premium. But the higher the stock price goes before expiration, the bigger their loss can be. You can learn more about call options in this article on our website, incomeshares.com. I'll leave a link to that in the description. Let's now flip things around and look at put options, because income ETPs also sell these to generate potential income. A put option gives the buyer the right, but not the obligation, to sell a stock or other asset at a set price, again, the strike price, at some point in the future. So here, the buyer is basically betting that the stock price will fall below the strike price. If the stock then does drop below the strike price, it makes sense for the buyer to exercise their right to sell the stock. They can sell the stock at the higher strike price instead of the lower market price, so they're protected. For the option seller, it's the opposite again. They might have to buy the stock at the higher strike price, which can mean taking a loss if the market moves lower. Just like with calls, the put seller earns a premium up front, which they keep regardless of what happens. And if the stock price stays above the strike price and the option expires worthless for the buyer, that premium becomes pure income. On this hockey stick diagram, you can see the option seller's maximum profit is capped at that premium, and losses build up as the price drops further below the strike price. You can learn more about put options in our article on the Income Shares website, and I'll leave a link to that in the description too. So before we wrap up this video, here's a quick overview of the 3 main strategies you'll see inside income-focused exchange-traded products. First, there's covered calls. That's when the fund holds the asset and sells call options against it to collect option premiums. That gives investors income potential while still keeping some upside to the stock. Second, there's cash-secured puts plus equity. Here, the fund holds a mix of cash and shares and sells put options. It still earns option premiums, but with a slightly different balance of risk and reward. And third, there's the 0 days to expiration put right strategy, or ODTE. As the name suggests, these ETPs sell put options that expire on the same day. We'll look at each of these in more detail in later videos, but for now, just remember that they all follow the same core idea: selling options to collect premiums, which could become income for investors. Now, there are 3 key risks to understand when it comes to income options ETPs. First, the ETP's value moves with the assets that it tracks. If those rise, the ETP can rise too. If they fall, so can the ETP. Now, it obviously doesn't move one for one because it doesn't hold a full position, but it can move with the asset. Second, selling options limits upside potential in strong markets. The ETP earns income but gives up part of its potential gain. But that's the potential trade-off with some of these strategies. And third, the ETP's net asset value can gradually erode over time. That happens for 2 reasons. One, the income that's paid out to investors isn't reinvested in the fund, so the ETP's base value doesn't grow by as much. 2, when the fund regularly sells and replaces options, small trading losses can build up over time. So even though investors can earn regular income, the ETP's NAV can slowly drift lower, and that's normal for income-focused products and something Income Shares aims to manage. You can learn more about NAV erosion and what many investors get wrong about it in our article, What Investors Get Wrong About NAV Erosion. Link in the description. So that's the end of this video, and here are the key takeaways. Number 1, options income ETPs sell options to collect premiums that can be paid out as income to investors. 2, call and put options are the building blocks of every options income strategy. 3, the 3 main approaches are covered calls, cash secured puts, and 0 days to expiration put writing. And finally, number 4, ETPs can rise or fall with the underlying assets, have less upside in rallies, and may see NAV erosion over time. So thanks for watching this video. To learn more about covered calls and other income strategies, check out the related videos and articles linked in the description. And if you'd like to go a bit deeper, feel free to sign up to our mailing list. You'll also get a free copy of the Income Shares PDF guidebook when you do that. You can also subscribe to the channel for more educational content on income options strategies. Thanks again, and take care.